Where do I even start today, guys? Where do I start? It's currently about 10:30 a.m. on the East Coast, and the markets are not looking good after we got the jobs data this morning, the unemployment data, which we're going to break down later in this video. We currently have the Russell down 1.5%, so the Russell has been in the ringer, guys. It is still getting destroyed day after day after day, as the NASDAQ is down 0.3, the S&P is down 0.4, and we have the Dow Jones down 0.1. So in terms of those indexes, it's not that bad, but again, the Russell's getting destroyed, and we have the VIX up, which is a little bit alarming, 7%, as now the VIX is back in the mid-20s. So yeah, we got a lot to break down in this video, so if you all find value, hit the like button, make sure to subscribe, and don't forget to get up to 17 stocks from Moomoo. It is free money, guys. Use that link down below. Open up an account. You get 1 free share of stock. Deposit at least $100. You get 6 more free shares of stock, and if you deposit at least $1,000, you get 10 more stocks, totaling 17 stocks from Moomoo, guys. And of course, that link down below, the Moomoo link, does help out the channel. And with that being said, let's dive into the video. So look at that. Again, like I said, everything is all over the place. Well, not really. It's mostly in the red, but we have a lot of volatility out there all across the board. We have the VIX up over 7%. The metals are through the roof today. We have silver up 3.2%. We have gold up 1.8%. So big bounce back day for the metals, which is nice considering those have not been doing well. You guys have heard about that, especially if you've been watching this channel. And if we pull up the 20-day chart on SPY, let's take a look at this very quickly. We are clearly taking out the lows, or rather we did already take the lows out from yesterday, which you guys can see the markets yesterday completely collapsed, not only during the day, but also in the aftermarket. SPY went from about 391 all the way to 388.50 in the aftermarket. So we took out the lows not only from intraday yesterday, but also from the aftermarket on SPY. And let's see what Triple Q is doing. Probably the same, right? Yeah, it is the same, guys. We took the lows out from yesterday, not only intraday, the intraday session, but also the aftermarket session. We hit under 290 today on Triple Q, although it is now above 291. It's rebounded a little bit. We still hit under 290, which is not a good sign at all for the bulls. You guys can see the 20-day chart. We're almost at the lows now on Triple Q from back in the beginning of March. If you guys have been watching SPY, you know SPY's already past the lows from the beginning of March. So bears are 100% in charge on SPY, on Triple Q, and don't even get me started on the Russell, guys. Like I said, the Russell's just been getting clobbered day after day after day. Just a couple days ago, 7 days ago, 1 week ago, guys, last Friday, the Russell was at 1930. Now it just hit 1785. We're talking about a 7% drop, 7.5% to be exact, in just a week. That is just complete abomination here in the Russell 2000. It's just not looking good, guys. And that head and shoulders that we called out clearly played out. And now we're starting to see a little bit of buying coming in here at about 1785, 1790, which we actually mentioned that level. I think that was yesterday. You guys can see that was support back in August of 2022. Also, that was resistance back in June 2022. And it's held, as support multiple times throughout the past couple of months. So maybe we get a little bounce at 1790, 1800, maybe, big maybe there. But if we fail at that point, just know 1730 is the next gap to fill to the downside. So let's break down the actual jobs report, guys. And by the way, if you're finding value, smash that like button. I appreciate you all as always. Let's start off here on Forex Factory, which we'll see all of the data right off the bat. We'll talk about the average hourly earnings month over month first, which you guys can see. This is the change in prices, in the price businesses pay for labor, excluding the farming industry. You guys can see that right here. And this is released monthly, usually on the first Friday after the month ends, which is right now. And the next release is going to be coming April 7th, 2022. And why do traders care? Well, it's a leading indicator of consumer inflation. When businesses pay for more labor, the higher costs are usually passed on to the consumer. You guys see that right here. So what did the average hourly earnings month over month come in at? Well, we can see right here, they came in, I believe, at 0.2%. You guys can see that number right here. Let me zoom in a little bit. That's the actual number here. The forecast was 0.3%, so it actually came in a little bit less than expected. And last month, they reported a 0.3%. So not as much of an increase in the average hourly earnings as expected. And I can't say the same about the non-farm employment change, which you guys can see right here. If I zoom in a little bit, this is the change in the number of employed people during the previous month, excluding the farming industry. This is vital economic data that's released shortly after the month ends, and the combination of importance and earliness makes for hefty market impacts. You bet you know what on that one, guys, considering how crazy the market is right now. You can see this shows job creation, and of course, it's an important leading indicator of consumer spending, which accounts for a majority of the overall economic activity. So let's dive into this, guys, because this number came in hotter than expected. You can see here it came in at 311,000 versus the 224,000 forecasted. That's a lot higher. And last time it came in, last month, it was at 504,000. So it's a lot lower than it was last month, but it's a lot higher than what we saw on the forecast, which is why the markets are selling off. One of the big reasons why the markets are selling off. So let's actually dive into that very quickly. We'll take a look at the actual report here. Bear with me, guys, as I do make my face a little bit smaller. There we go. This shows you right here, this chart right here shows you the unemployment rate seasonally adjusted from February 2021 to Feb 2023. So that came in, I forgot to mention the unemployment rate, that came in at 3.6%, I believe, which it was expected to be, you guys can see here, 3.4%. So you guys remember, I forget that guy that was really roasting Powell the other day as he was testifying. He was saying that kind of trying to get Powell to spit out the fact that Powell is trying to get the unemployment rate to go up. I think he was saying something along the lines of history shows that if inflation's at 6.4%, to get it down to 4.4%, the unemployment rate has to go up to like 5 or 6 or something like that. Then to get inflation down to 2%, unemployment rate has to go up to 10%. You guys probably remember that if you were paying attention to the testimony. He was trying to, grill Powell on that. And of course, Powell was not really going to be upfront and be like, yes, we're trying to get the unemployment rate as high as possible, or maybe not as high as possible, but we're trying to get it up to bring down inflation, cool off the economy, right? He didn't really say that, but at the end of the day, Powell is trying to get the unemployment rate to go up, and he did. He did that a little bit here. 3.6% is what it came in at when the estimate was 3.4%, and last month it was at 3.4%. So the unemployment rate is creeping up ever so slightly here, and if we come over here back to this chart, you guys can see the unemployment rate has come down a good amount from February of 2021, where it was over 6%, and now, of course, 2 years later, it's in the mid-3s, and it's been here for about a year. You guys can see since last February, the unemployment rate has been hovering between 3.5, 3.7, and now it's starting to creep up, and I would say, well, it's not completely, the trend's not completely starting to turn here, you guys can see, but it is creeping up a little bit compared to what it was last month, and let's say we start creeping up into the 4s, 5s, the markets are going to like that because that is going to show what Powell is doing here to bring down inflation and to cool off the economy. It's actually working, which we're not really, we are seeing inflation come down a little bit, but the jobs market is still hot. Let's be honest, guys. It is still hot. Non-farm payroll, you guys can see the, the chart here. It has been coming down. The month-over-month change has been coming down. But again, like I said, we just got a hotter number than expected. The markets are not liking that because that could mean Powell's going to be raising rates a little bit more aggressively. Maybe 50 basis points is on the table. Maybe we're going to go higher on that Fed funds rate than expected. So if we come down a little bit here, guys, let's see here. Among the major worker groups, the unemployment rate for Hispanics increased in February. Unemployment rates for adult men, yada, yada, yada. We're not going to get into that in this video. I kind of just wanted to go over what, in terms of what categories added the most jobs? Where do we not see job gains? So in February here, you guys can see notable job gains occurred in leisure and hospitality, retail, trade, government, and healthcare. Employment decline in information and in transportation and in warehousing. You guys see that right here, right? And leisure and hospitality added 105,000 jobs in February, similar to the average monthly gain of 91,000 over the prior 6 months. So it's actually over the average from the past 6 months. So that goes to show, right? It's pretty hot out there. Food services and drinking places added 70,000 jobs in February, and employment continued to trend up in accommodation. You guys see that, plus 14,000. And if we come down a little bit more here, employment in retail trade rose by 50,000 in February, reflecting a gain in general merchandise retailers of 39,000. Government employment increased by 46,000 in February. You guys see that, about the same as the average monthly gain of 44,000 over the past 6 months. You guys see that. And employment in professional and business services continued to trend up, plus 45,000 in February, with the gain of 12,000 in management, scientific, and technical consulting services. And let's see here, employment in business and professional services increased by an average of 35,000 per month. Let's see, healthcare added 44,000 jobs in February. Construction employment grew by 24,000 in February. Employment and social assistance rose by 19,000. You guys see all these numbers here. And in February, the information industry lost 25,000 jobs, so they're losing jobs there. Transportation and warehousing lost 22,000 jobs. That's not a good sign. And employment showed little change over the month in other industries, including mining, quarrying, however the heck you say that, guys, and oil and gas extraction, manufacturing, wholesale trade, financial activities, and other services. And you can see here in February, average hourly earnings for all employees on private non-farm payrolls rose by 8 cents or 0.2% to $33 an hour. Over the last 12 months, average hourly earnings have increased by 4.6%, and in February, average hourly earnings of private sector production and non-supervisory employees rose by 13 cents or by 0.5% to $28.42. So if you guys want to go through this and read it on your own, I advise you to do that, because this thing is massive. As you guys can see, look at all these pages here. We're talking at least 30-40 pages of stuff here. So go read it on your own. But all you have to realize is jobs data came in a little bit higher than expected. Sure, unemployment rate is inching up, but not enough in my opinion. It probably will come up even more in the future, but right now it's still fairly low, 3.6%, and the stock market is not really too fond of this right now, because they're speculating, the stock market's speculating that the Fed's going to be more aggressive now, more hawkish, to try and cool off the labor market and to try and bring that unemployment rate up, and of course, in turn, bring inflation down, which is obviously one of the main goals here that the Fed has as of right now. So markets are bleeding even more as the course throughout the course of this video, guys. Now we have the S&P 500 down 0.7%. Earlier in the video, I think it was down 0.3, 0.4. We have the Dow Jones down 0.3 right now. The NASDAQ's down 0.6 as the Russell's almost down 2%. Now the VIX is up, get this, guys, over 10%. Look at that massive move here on the VIX. And I did not trade UVXY, which, dang it, guys, we called this thing out to a T, but I did not end up trading it. This thing's up from $4.37 yesterday. Now it's pushing to $6. It is up 35%. Dang, I'm an idiot, guys. I should have traded this thing, but oh well. We'll see if it cools off. Maybe we can get a better entry point on UVXY. And that's it, guys. That's it. With that being said, I'm going to wrap up the video. If you enjoyed it, hit the like button. Make sure to subscribe. And don't forget to get up to 17 stocks from Moomoo. Use that link down below. Open up an account. You get 1 free share of stock. Deposit at least $100. You get 4 more free shares of stock, plus 2 shares of either AI or BBAI. And if you deposit at least $1,000, you get another 10 stocks, free stocks on top of those 7. So depending on how much you deposit, you get a lot of free stocks, guys. And with that being said, and mind you guys, it is an affiliate link, so keep that in mind. It does help out the channel. And with that being said, I'll catch you all in the next video. Peace out.